This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers security through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. My name is Joel Garris, and for the next hour, it is the program we all know and love. Central Florida's longest-running radio program, started back in the early 80s by my father-in-law, Jack Nelson, continued today by me, yours truly, Joel Garris. Here's what we do on the program each and every week. We talk about anything and everything to do with your dollars, helping you make sense out of all of those different decisions that have anything and everything to do with the dollars, whether it's educating your kids, retiring successfully, planning a major purchase, I don't know, taxes, maybe that's on your mind. If it is, I'm sorry you waited to the last minute. Today is, in fact, April the 15th, which would be the day that you would have to file your taxes on. But, of course, today is Sunday. So that means that you have until tomorrow. But wait, tomorrow happens to be an obscure holiday in the District of Columbia called Emancipation Day. And because it is a holiday in the District of Columbia where our federal government is based, then that day doesn't count either. So the real deadline is Tuesday, April the 17th. So make sure that you get them done by Tuesday. Otherwise, the IRS isn't going to be happy. Now, if you're not able to get it done, don't just ignore it. File an extension, okay? Because the failure to file penalty is pretty significant. So make sure that you file an extension. That extension gets you to August, and there's another one that you can file in August that gets you all the way to October. So there is a lot of room to still get your homework done if you have not gotten your homework done previously. Now, one of the things that you want to be aware of is that if you do file that extension, you probably want to take a moment and at least rough figure, back of the envelope type stuff, whether you're going to owe money. Because if you think you do, with that extension, you want to throw in some money that is equal to that amount that you think you're going to owe. Because if you don't, that's when you get hit with a pretty stiff penalty on that amount that you owe. The last thing you want to do is extend and then be writing a check to the IRS in October, because then that means that there's 6 months, of that penalty that deals with the fact that you did not pay in enough by April the 15th. So you got to at least come up with some kind of a number to try and come up with a guess as to how much you need to put in, because the last thing you want to do is let that percolate along out there and ignore it. And then lo and behold, you wind up owing a bunch of money. That amount is going to be a bit higher because of the failure to pay on a timely basis. So that's fine if you need an extension. No big deal on that. Much better to file an extension than just completely ignore it. But the second part of that is you probably at least want to have an idea as to whether you're going to owe or not. Now, what's the best way to figure that out? Well, you probably just want to take a look at last year's taxes. And chances are, if you can't get anything together at all on it, okay, your best resource for what you owe is going to be last year's taxes. So if you owed on last year's taxes, you probably want to use that number as your baseline number. If you just can't even come up with a guess, look at last year's taxes. For most people, things don't change from one year to the next, for most. Now, obviously, if there was something different that happened for you last year, then look at that particular transaction. Maybe you sold a property, okay? Maybe you took a large withdrawal out of an account. Look at that transaction and then kind of figure out what the taxes are on that. But you really got to at least take a guess, take a shot, and throw that money in. Otherwise, you're going to wind up owing that plus a pretty decent penalty on that. That one, the penalty you probably want to try and avoid. That is for sure. So anyway, we've got open lines, of course, here on the program, 407-916-5400, toll free 1-855-545-1025, or you can send us an email. That email is, of course, my first name, Joel, Joel, and then it's at the little A with the little circly thing around it. And then it's NelsonFinancialPlanning.com. So Nelson Financial Planning, that's obviously where we are Monday through Friday. Today is Sunday, of course, which means we're sitting here in the studios talking to you. Maybe you're sitting there trying to figure out your taxes and you've got a question. Feel free to give us a call or send us an email. The headlines this past week were certainly all over the map once again, right? So this past week, we had old Mark Zuckerberg doing some testimony to a bunch of people that probably don't use his platform. So that was kind of a little entertaining as to some of the questions that he got. But you had a continuing conversation about trade, and then you had Syria, and then you had Paul Ryan resigning, and then you had Trump's private attorney getting raided by the FBI. That was just this past week. Those types of headlines continue to contribute to volatility. As we shared with you, I think it was last Sunday, statistically, the volatility that we've seen so far this year is comparable to what we see about 15% of the time, going back for the past 60 years. So all the way to 1958, you typically will see the level of volatility in the first quarter that we have seen so far this year. The bad news on that statistic is that generally those years continued their more volatile trend. The good news is that the average total return in those years was about 9.6%. So some perspective on that. Certainly, there's a lot of headlines out there that are adding to the volatility. But the reality is, since June of 16 until January of this year, the market had basically gained about 44%. So some perspective on that. So you have a pretty significant gain within a relatively short period of time when you stop and think about it. June of 16 to January of 18, that's what? 18, 19 months, right? And then, of course, from early February until now, there's been a decline of about 9%. And it's funny, these declines always are the thing that sort of keeps people from achieving the investment results that they should be getting over time. It never ceases to amaze me just how short the memory is when you go through a period of time where the market goes down. So we'll give those numbers again. So from June of 16 to January of 18, the market was up 44%. In February and March, market goes down 9%. The fact that people are fixated on the down 9 sort of really highlights the fact that people kind of lose track of the good news, right? Because if you said to somebody, wait a minute, you're going to make 44, but then you're going to lose 9, that's a pretty good proposition, isn't it? And doesn't that still put you ahead by 35 within a 20-odd month period of time? That's pretty good. And what history tells us is that it is, in fact, quite normal, as we were sharing with that statistic. We've got some more comments on market volatility and some interesting perspective looking back over the past 70 years. And then we'll talk a little bit about the FANGs today. What are the FANGs? Well, we'll explain all of that when we get back right after this here on Dollars and Cents. This is Joel Garris, News Radio 102.5 WAFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. For our friends over on 540 AM, we're simulcasting over there as well. Talking a little bit about some volatility out there in the markets, and certainly the headlines of the past week. When you rattle them off, a lot going on. The reality is that looking ahead to this week, well, I suspect that we will continue to hear more about trade. We'll probably hear more about Trump. I don't know, maybe. We'll hear more about him. And then, far more importantly, it is earnings. Well, of course, tax filing deadline, too. Don't forget about that. It is, in fact, earnings season. Earnings season coming out. The start of earnings season is, of course, when companies wind up announcing their earnings. It should be I'm sorry, I'm looking for the statistic I saw on that today. I think it's going to be the strongest year for earnings since 2010. So some pretty strong earnings for the week ahead. I'm not finding that statistic right this second. But look for earnings to help really drive some perspective on the markets. Once again, the earnings that come out, this is the first quarter ended, and so companies are announcing their earnings in the weeks ahead. Traditionally, what has been happening of late as the earnings have gone, so goes the market. It appears that earnings are on track for nearly a 15% growth over a year ago. Now, stop and think about that number. 15%. That's pretty good. So corporate America, despite all of the headlines, is in fact making money. Not just making a little bit of money, but making a whole lot of money. And so certainly that is something to watch next week and in the weeks ahead as we go through earnings season in the weeks ahead. Sort of starts off this week with a bit of a bang. A bunch of banks, things like Netflix and all that, announce on Monday, and then on Tuesday it's Johnson & Johnson, United Health, Goldman Sachs, and then it sort of continues on through the week. So big week for earnings. So kind of that will be a part of the big driver of the market going forward. The obviously Facebook last week had a lot of attention and a lot of conversation. You know, it's fascinating. History certainly has a familiar story in how things happen in the advancement of technology and society. Although I guess has society advanced because of Facebook, or maybe regressed because of Facebook? That's a different philosophical conversation. The reality is that these companies, these social media companies, are brand new. And much like the automobile, when it was first introduced, there was a lot of things in the automobile, or some things that weren't in the automobile, that we now take for granted, right? Easiest among those is seatbelts and airbags. And if you're like me, what's a car seat? I mean, seriously? You just strap in and, So automobiles have clearly transformed. And what we take for granted in an automobile today is very different when automobiles first came out. The same thing, I think, is true for a lot of the social media stuff. This is brand new stuff, and the impact and the effect that it has is going to go through a series of changes and evolution. And you're going to see regulations come in and regulations come out, but ultimately it will change. And I think this conversation about Facebook and kind of the information that was readily available to be taken advantage of is something that we will see a bit of a watershed moment in terms of some of the regulations that will come out now involving how social media and privacy rights begin to coexist, if you will. So certainly we see that changing over time. But clearly, as a result of the exponential growth, the FANGs, if you will, as they're called, which FANGs basically stands for Facebook, Amazon, Apple, that's the F, the A, Netflix, okay, that's the N, and then the G is Google, except they don't call themselves Google anymore. They call themselves Alphabet. So it's really now Fana is really, but FANGs sounds so much better. So we'll go with that because that's nobody's adopted my Fana thing. So the FANGs. Here's the thing that you need to realize about them, and particularly in reference to what's going on in the market indexes. The reality is that those companies have had some exponential growth of late. And so that exponential growth of late has propelled their market valuation, big market valuations, particularly relative to where they were 10 years ago. Well, what you may not realize is that the market indexes, say the S&P 500, are in fact market-weighted averages. So they're not just straight arithmetic averages where you got 500 companies, you add them all up, you divide by 500, and poof, that's the average. That would be how you would do it if you were, still in high school. Which, as an aside, we're doing a lot of that right now at the house because it's the fourth quarter, and we got to get certain numbers in order to pull up the average. That's an arithmetic average, but a weighted average is very different. A weighted average takes the guy that has done the best of late and ascribes more to him than the other guys. So what that means is that the market indexes today are quite a bit heavier on the FANGs than you might realize. As a matter of fact, if you take the FANGs and you look at the S&P 500, those 5 companies make up over 10% of the performance of the indexes, particularly when you toss Microsoft into that mix. Now, Microsoft isn't considered part of the FANG because it's not quite on the social media type of side of things, but if you put Microsoft into the mix, that's a very small handful of companies that drive a tremendous amount of the performance of the S&P 500. So a little perspective on that is one of the reasons why, in particular, you're seeing that heightened level of volatility in the indexes right now is because of the issues that are going on the social media and the FANG side of things, is because there's a lot more volatility in those particular companies these days for various issues. Facebook, obviously, for the privacy stuff. Amazon, for the suggestion that they're getting a better deal through the U.S. Postal Service. Those kinds of things are affecting the valuation of those companies more than sort of a broad-based effect on companies as a whole. So that is driving a little bit more of the index today than you would imagine, simply because that index is weighted average. Because that index is weighted average, then there's a much greater impact when those companies have volatility. So just remember some perspective on that and the positioning of where those companies reside, particularly relative to the index, because they're certainly helping to drive a little bit more. Want to get to the statistics that we were talking about before the last break. So we'll slide into the bottom half of the hour here. And we come back, I want to give you the statistics on a long-term perspective about volatility and bull markets versus bear markets. We think it's very interesting, and it helps to provide some perspective on markets going up versus markets going down. We'll spend some time on that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents on News Radio 102.5 WFLA.
WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, ladies and gentlemen, welcome back to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA. We've got some open lines this morning. 407-916-5400. Toll free 1-855-545-1025. And then, of course, the email, which is always open, Joel, Joel, at NelsonFinancialPlanning.com. That's the email. So that one you can use anytime you want. The phone numbers are only good between 9 and 10 on Sunday morning. So some perspective. So if you look at the past 70 years, it's funny, people are so fixated on, a bear market. I'm going to lose money. It's going to be painful. Bear market, bear market, bear market. And that's all you hear, okay? If you search the internet, okay, you'll find 100 times more articles about bear markets than you will about bull markets. I mean, try it sometime. Just Google it, okay? How many different articles pop up? But what's interesting is that bear markets don't happen very often. But yet, many people build their entire investment strategy around the fear of the next bear market. So we'll give you some perspective on that. So if you look over the past 70 years, and again, bear market defined by a 20% or more decline in the markets. Okay. So 70 years, take a wild guess at how many bear markets have been over 70 years. 9. So 9 out of 70. Okay. So what's the average decline in a bear market, you say? Well, it's 33%. Some bear markets are just over 20. Some bear markets are more. Average decline in an average bear market is 33%. How long does it take to get through it? On average, looking over the prior 9, takes about 14 months. So 33% of the time, 33% decline, on average happens within a 14-month period of time. Now, 14 months is not, I would submit, not that long. So bear markets have a tendency to be relatively quick. Now, let's turn to the flip side. And let's look at the average bull market over said 70 years. Bull markets, on average, last quite a bit longer, 70 months, and return, on average, 268% during your average bull market run. Okay, so let's put some perspective on these numbers. 268% versus minus 33%. That's a pretty big gulf, don't you think? The positive number is a whole heap a lot bigger than the negative number. Oh, and by the way, it also occurs over longer stretches of time as well. Now, why do you suppose that's true? Well, it's fundamentally true because if you think about the economy, then what you'll realize is that, well, you know what? The vast majority of the time, the economy has a tendency to expand. And minimal amounts of time, there's a tendency for the economy to contract. Why? Because human beings, which ultimately are the drivers of the economy at the very base level, I think are structured to want to work, to want to do, to want to improve, to want to achieve. I think that's we're talking basic human nature that underlies all of this stuff, okay? Because you don't have a company without a human being. There has been no company that has been invented that has delivered a product without a human being involved, right? I mean, can't happen. So at the base level of all of this is fundamental human nature. And fundamental human nature wants to achieve, wants to succeed, wants to strive for betterment as a whole. But yet when you look at these numbers, there is a fixation on the bear market scenario. And when you stop and look at it in perspective, what you should really come to the conclusion is, why am I worried about that? Why am I worried about that? Shouldn't be. You really shouldn't be. Right? I mean, everybody should be investing for the rest of their life, not for the rest of this quarter, the rest of this week, the rest of this year. Because if you look at it from that perspective, the numbers are overwhelmingly such that there should not be this grand fixation on bear markets. Give me the numbers again. Average bear market, 9 of them over the past 70 years. Average decline is 33%. Average period of time it takes for that decline to happen is 14 months. Average bull market, 268%. 268%. Folks, let me do some math. 268% 268. I got to pull out the calculator for this one, folks. So hold on. I got to put the little PIN number into the phone. That's a little security thing that we do. 268. So 8 times, that's like an 8. That's like a 9 because it's a negative number. So like it's 9 times greater. Average bull market return 268% over a 70-month period of time. But how many people have let the fear of a bear market fundamentally destroy their retirement, destroy what they're working to achieve? Because somebody whispers and says, or in the case of the media, somebody's yelling that, it's going to be bad, it's going to be ugly, it's going to go down, and you're going to lose a lot of money. And what you should do is ignore that stuff and rest in the numbers that show the past 70 years. It's not the markets that cause people to lose money. It is, in fact, investor behavior that does it time and time again. The numbers are overwhelming. 268% versus a minus 33. Come on. Got to look at it from that perspective. But my goodness, when the market goes down any amount, it's just Katie bar the door, and it's going to just, it's all going to end tomorrow. Well, if it all ends tomorrow, then guess what? You don't have really an investment strategy to prepare yourself for that. Reality is that if human behavior continues the same as human behavior has been, then fundamentally, it's a pretty good approach to be an investor. We will slide to the break. We've got our last segment. We'll talk about some rental property. We'll talk about some tax issues. Well, you know what? It's April 15th. I almost got through the show without even talking about taxes. Well, we talked a little bit about the deadline. But, of course, we will, hit some tax topic in the last segment. Talk about some tax pitfalls of rental property, investment property. So stay tuned for that. We've got some interesting perspective on that here on the program. Dollars and Cents with your host, Joel Garris, on News Radio 102.5 WFLA.
All your favorite stations, all free.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA. And, of course, we simulcast over on 540 AM as well. Can't forget that old AM dial. We still got a lot of folks that listen on the good old AM dial. So we welcome them to the program as well. So as you know, continuation of kind of the conversation we were having in the last segment, you know, many people really let the fear of a bear market ultimately undermine their success. And one of the questions as investors, and one of the questions that leads folks to do is they always sort of look at, okay, well, what are the other options? What are the other options? Because we are, constantly looking, but yet at the same point, never quite accepting the truth that over time, your performance as an investor in the stock market is your best potential rate of return. I mean, the numbers are overwhelmingly in favor of that, but yet many still look elsewhere. One of the questions that we get often is on rental property, and let me be clear, it's not to say you can't make money in rental property. Of course you can, but by the way, it's not quite as easy as they make it look like on TV. Okay, so let's just be clear on that. I'm always fascinated when I watch those shows at what they can find people to do stuff for, like the cost of the demo and cost of cabinets and cost of tiling and stuff like that. I'm always fascinating where they find these people that will do it for the price, because whenever I've priced out anything like that, maybe I'm not liked. I don't know, but the price is never the price that they say on TV, right? Well, I rehabbed this whole house and $30,000, and that's all it was. And I replaced the kitchen, and I redid every room, and I moved walls, and I replumbed, and I redid the landscape. I'm like, maybe I'm just not dealing with the right people, because my cost of doing that stuff, price that I get for that stuff is a lot more than that. But anyway, I digress. Here's one of the things you need to realize from a tax perspective. So we were talking with somebody just this past week about this, and they were saying, well, what are the other options out there? And I want to do rental property. And I said, well, what you have to realize is that you're for this particular couple relatively successful, making good income, $170,000 or thereabouts combined between the two of them. And what most people don't realize about rental property is you don't get to take the write-off of your rental property once your income goes above $150,000. See, most people don't realize that. If you're making good money, your ability to write off your loss is quite limited. A lot of that loss is the depreciation that you take on the property. So here's how rental property works. You purchase it for a set amount of money, and then that purchase price you get to write off or depreciate over time, over a 39-year period of time. So that means that there's a subtraction on rental property that isn't a real cost. It's sort of a fake cost because it's depreciation. It's basically spreading out the write-off of the purchase price over an extended period of time, over, in theory, the lifetime of the property. So if you look at the numbers and, you've got your rent, and then you've got, if there's a mortgage, and you've got the mortgage interest, and then you've got real estate taxes, and then you've got upkeep and, insurance and advertising, whatever else is in there, okay? So all of that comes into play. And if you're fortunate and you're running a little bit to the positive on those cash flow numbers, usually the depreciation offsets that and results in a negative number on owning rental property. You can't take that as a write-off against other income if you're making above $150,000. It starts to flow. It actually starts to phase out as you approach that $150,000 number. So what happens is you then have to carry that loss forward. And if your income still stays above 150, then you just keep carrying that loss forward indefinitely. The only way you ever capture that loss is when you dispose of the property. You have to sell the property in order to bring that loss back into the mix. So if you're thinking about, I'm going to do rental property and it's going to help me on my taxes and all that, watch out. That might not be true at all, particularly if it's a couple of folks making decent money. Once you get above the threshold, then you don't get to write that off. So that's one of the tax pitfalls of owning rental property is everybody thinks it's going to be a big write-off. The reality is it very quickly cannot, and then you're carrying forward this loss for years and years and years and years to come. And then when you sell it, here's the other part, then you get to use that loss, but then all of that depreciation also gets recaptured. So you can have a big looming tax bite when in reality you wind up selling the property. So just be careful of that if you're thinking about going into investment property, rental property. And again, not to say that you can't make money on it. There are many successful property owners out there that have done well, as with anything, okay? Whether it's the market or whether it's real estate, it really does pay to be consistent and to stick with it, with anything in life for that matter. So when you look at the numbers on it, just be aware that if you think you're going to be able to generate a loss that's going to help you on your taxes, if you're making good money, you don't get to have that. Okay. In fact, you wind up just carrying that forward time and time again. And the reality is that that winds up being a bit of a tax issue going forward, particularly when you then turn around and sell it, because then you have to recapture all of that depreciation. You get to use the carry forward loss to help offset some of that, but it always makes the disposition of the property a little bit more taxable than you realize, because you have this kind of thing that you haven't been able to use coming forward, and then it gets recaptured and those kinds of things. So just be aware, particularly if your income is higher. The write-offs on an investment property are not what you think they are, particularly at a higher income level. So just be aware of those pitfalls, if you will, of rental property. That's one of the limitations, certainly the limitations of it, combined with the fact that, there may be some unreliability of the tenant that you've got in the property, no matter how good or your process is to select and pick. It may be somewhat tricky to find somebody who's always going to pay on time and not wear out the property, if you will. Anyway, so that's just some perspective. Again, if you missed the first part of the program, obviously today is April 15th. Taxes are due not tomorrow. Well, today's Sunday, so not due today. Not tomorrow because it's a holiday in the District of Columbia, but rather on Tuesday, April the 17th. Make sure you file. If you're not ready to, if you don't have your homework done, make sure you at the very least file an extension and take a guess as to how much you owe. It's important to at least put that money in that you think you might owe, because there's a penalty on the payment if you're going to send the payment in months or so down the road. So just be aware that you really want to take and look at how much you owed last year as at least some guide to how much you should be putting in on April the 17th. If last year was a year where there was some different stuff happening, then you need to take that into account as well as you do that back of the envelope analysis on how much has got to get paid in to your taxes. So just be aware of that and that deadline. No problem getting an extension, okay? That's very easy to do. But the reality is that you really want to be careful when you do that to also have taken a look at how much you're going to owe, because there is a penalty on that if you wait and pay that in the months ahead. So just be aware of that. Well, the music means we are out of time, and we will wrap it up for another Sunday morning here on Dollars and Cents. Thank you all for listening. This is Joel Garris of Nelson Financial Planning, and you're on News Radio 102.5 WFLA.
This is Bud Hettinger. And you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.